Good morning, it's Jeff Christian. It's not quite 10 o'clock on Friday, the 22nd of October here in New York. Gold is breaking above $1,800 and silver is over $24.50 this morning. I'll talk a little bit about that toward the end of this. I wanted to talk today about long-term trends in global GDP. It's a little bit aside from precious metals, but it's actually not. It's core and central to understanding what's really going on in the world, politically, economically, and financially. And it obviously has a major implication for precious metals markets there too. I'll show you some work that we did a couple of years ago on it, and I'll also talk about that. Then I will give you a market update of where we think the market's going. We are issuing trade recommendations this morning on gold and silver. Excuse me for a second. And I want to give a little bit of advice to some silver investors toward the very end of this presentation. I started writing some notes for what I hope will be the last video of the year before the holidays. And the working concept is, what have we learned in 2021? And a lot of people have learned a lot of things, good and bad, in 2021. And one of the things I learned this week was very surprising to me. It's something that I hadn't looked into because it's not germane to what I do as a business and as an investor, but it's very interesting and very germane to silver and gold investors who might wonder about the world. So these are the world's largest economies last year in GDP. Nominal GDP is measured in trillions of US dollars. Some people look at what they call purchasing power parity, which says, well, what's a dollar's equivalent purchasing power within a given economy? Sort of like the Big Mac index. You know, it may cost $3 in New York, but $1 in another country, so you adjust it for that. We don't particularly like purchasing power parity. We look at it for a variety of reasons, but the best way to look at GDP, in our view, is to look at it in unadjusted US dollars. The US economy is still the largest economy measured that way. It's about $20 trillion last year. That was down sharply from 2019, but it's the year for which we have full year data, the most recent. That was about 24.6%, a quarter of the global economy. Now, some people decry the fact that after World War II, when the rest of the world was in shambles and the US had been built up very sharply because of the war effort, the US was something like 44% of global GDP. And the US government, rightly so, made a conscious decision to help the rest of the world rebuild, because the view was, if these other countries remain impoverished and damaged, that is a breeding ground for radicalism, both on the left and the right, both nationalistic, national socialism, fascism, and communism and radical socialism. So the US government said it behooves us, from the perspective of our own best interests and the interests of the world and avoiding World War III, to help the world build up. And we will diminish our stature in the world that way, but we will be better off. The world will be bigger, and we may lose market share, if you will, but we will have a smaller percentage of a larger market. And that actually has proven to be the case up until now. We are 25% of the market of the world GDP. China, about $14.9 trillion last year, is about 17.6%. And that's an important number because I'm going to show you projections from 2008 to 2030. And you know, the World Bank in 2008 was thinking that China could be around 16% by 2030. Well, it's already past that. It's 17.8%. And that's partly because China came out of the lockdown and pandemic earlier than the rest of the world. But China is growing. And the interesting thing is, the third largest economy is Japan, and it's 5.8%. And then it goes down and down and down. And I want to point out Russia, which is number 11 at 1.8%. I want to talk about Russia for a couple of reasons here, and partly because my next 3 slides come from a presentation I gave on Russian and Chinese perceptions of the world back in 2008 when I did these numbers. But this is the state of play as we are right now. The US is still the largest economy. China is coming up on us, and it will surpass us. And anybody who is rational in their views of where the world is going knows that China at some point will be a larger economy. We have 360, 380 million people. They have 1.4 billion. They've got all of the numbers. We've got 261 million ounces of gold in our monetary reserves. They have $3.2 trillion, mostly almost two-thirds of which is probably in US dollars. So they've got a lot of numbers. They've got greater land mass. They've got a lot of resources that they haven't even explored, let alone exploited. Now, if you look at 2008 and then compare that to the projections that were relevant in 2008 to 2030, and then 1820, which is the point. Now, as I said, this is material, the PDAC in 2017 asked me to, in 2018, talk about the way Russian government and Russian people, Chinese government and Chinese people look at the world. What are their perceptions and perspectives looking out at the world? And of course, you have to understand these are gross stereotypes. And in the case of Russia, you have a certain Russian perspective that people talk about. But if you look at the polls, it's maybe 50% or less of the population fits into those Russian perspectives. So it's a diverse population, as is any other country. But the governments of Russia and China have radically different views of the world. And that was one of the things that I was talking about. But look at 1820, beginning of the Industrial Revolution. China was a third of global GDP. India was another 16, 17%. Those two countries combined represented half of the world's GDP. The United States was down there at like number 10 with 1.8%. Early days of the Republic, early days of the Industrial Revolution. China and India opted out of the Industrial Revolution until the 1980s. And they lost a tremendous amount of status and market share, if you will, of global GDP. Since that time, they've come back. So by 2008, China had rebuilt itself up to the point where it was 6.3% of the world's GDP. And the World Bank thought, well, by 2030, they might be 15.5%. And as I said, they're already 17.6% or whatever. So they're growing as a percentage of the world more rapidly than people had thought. That's not surprising. India was 2%, and it was projected to be 4%. And if you go back here and look at this, you'll see that India is now about 3%. So it's on track. Russia was 1.9%, and it was projected to be 2.4%. And right now it's 1.8%. So you've got India and China growing again and growing in importance in the world. And that is the state of play upon which politicians and governments are reacting to China. And there are groups in the United States and in Europe and in other places that would like to see China's growth as a percentage of the world economy down. And that is behind a lot of the tariffs, a lot of the saber rattling, and a lot of the other things that are going on. But the Chinese will look at it and say, we used to be a third of the economy in the world. We probably won't be a third of the economy in the future, but we probably will be the largest economy in the world pretty soon, because we're now up to 17% and the US is down to 25%. So that's the sort of trend that's going on. I wanted to, just again, because I was talking about Russia and China in 2018, I pointed out Russia, by contrast, hopes, the expectation, the hope is that they're up to 2.4%. This is the difference between a managed economy where a communist government says, we want to adopt capitalistic practices, but under a communist control, which is what's going on in China, and a command economy or a centrally planned economy, which is what's going on in Russia. You see a diminution of power that has occurred in Russia from where it was in Tsarist times, 1820, to where it was under Soviet power. And it's growing again, but it's growing very slowly. And a lot of its exports are still natural resources. When I was in university studying international political economics, one of the reasons I got into commodities was because, if you looked at Russia and to some extent China at the time, Russian exports were oil, gas, timber, and metals. And you fast forward to 2021 and you look at Russia's major exports and it's oil and gas and timber and metals. They're still a commodities-based export market. China, its major exports are automotive components, electronic components, electronic goods, and other manufactured products that have value added. So that's sort of the state of play. It's a little bit aside from precious metals, but it creates the economic environment that causes a lot of people to say, okay, now I understand why there's been an upward shift in the investment demand curve for gold and silver, especially in North America and to a lesser extent in Europe, as people look at a world that is shifting away from them in terms of economic power. To the market outlook, CPM Group is issuing this morning new short-term trade recommendations for gold and silver. Gold has been trading actually in an ascending triangle, but it's sort of been range bound. But the lows have been higher over the last month since late September when it sold off. Gold sold off sharply in late September, and since that time, each low has been a little bit higher, and each high has been around $1,800. We are now breaking over $1,800, which tells us that maybe the vulnerability to downside is diminished. We still think it's quite possible that gold could spike down to 1780 or 1760 or even lower if you saw a period of time where the world became less concerned about economic factors going forward, less concerned about political factors, and more concerned about inflation. We don't necessarily see that happening. And our view, as you know, if you watch our videos, has been that while we thought that gold and silver were vulnerable to lower prices in October, we thought that they would probably move modestly higher in November and December, and modestly higher in 2022, and sharply higher later. And we still adhere to that view, but we're saying that the probability of another spike down is relatively diminished. So if you're a short-term investor in precious metals, our strategy would be to buy a straddle. Buy a put and a call, because we think that the price, relatively close in puts and calls, the price could move both lower and higher, and you might be able to make profits on both positions. If you're not buying and investing in options, then you got to be long, you got to be short, or you got to stand aside. And we've been tending to say, well, maybe we should stand aside, although we've been having sell signals in our gold and silver. But now today we're issuing a buy recommendation on a short-term basis, saying the probability may be shifting that you'll see 1810 or 1818 or maybe even 1820 gold before you see 1780. And with silver, it's the same sort of thing. You might see $24.85 before you see $24. Not a big move in silver or gold, but a little bit more of an inclination toward the upside. Now, I wanted to talk about another thing, which is, as I said, it's not what we normally look at, but there's been a lot of talk in the internet about how PSLV is a better silver ETF than SLV because you can take delivery. And I don't pay that much attention to that thing, to ETFs in general. But I looked at the prospectus for PSLV and for the prospectus of these parallel gold ETF, where you can take delivery. And if you want to take delivery of the gold ETF, you have to have 400 ounces of shares, worth of shares. Yeah, that's like more than $700,000 worth of gold. If you want to take delivery of the silver ETF, you have to have 10,000 ounces. I think it used to be, somebody told me it used to be 50,000 ounces, but now it's 10,000 ounces. You have to have the equivalent of 10,000 ounce bars to take delivery of silver through the PSLV. That's $240,000, $45,000 today. Most investors don't have that much silver or gold in an ETF or anywhere else. I mean, most investors don't have that much money, let alone that much money set aside in an ETF. So the idea that these ETFs are, that you can take delivery of physical metal is true if you're very wealthy. If you're an ordinary investor, it's not true. In addition to that, and I encourage everybody to download the prospectus and look at the redemption thing. It's really convoluted. I don't know that the manager charges anything for you to take delivery, but there are all sorts of other charges, and there are all sorts of issues that you have to take care of. You have, I think, 2 days. First off, you can only take delivery like 1 day a month. So if the price of gold or silver shoots up on, say, the 22nd of October, you can take delivery in the middle of November. And if you miss that date, I think it's the middle of the month, you have to wait another month. And then when you say, okay, I want to take delivery, you have like 2 days to organize the transfer of your assets from the shares to the metal. The metal gets stored at the RCM, which is a little bit out of the way for a lot of people. And if you want to take it and move it out of the RCM has an outcharge of 2%. You have to arrange for the armored truck or transportation to whatever facility that armored vehicle company will deliver to. And you have to pay for that. And you have to do a lot of other things. You know, when people ask me, you know, how do you buy gold and silver? My answer is always, you buy gold and silver. If you want to own gold and silver, buy gold and silver. ETFs have some advantage. Most ETFs you cannot readily redeem for the metal inside them. You're buying a share of an offshore company, the assets of which are metal, and you don't have a claim on that metal per se. You have a claim on the dollar value of it. PSLV and its companion gold, you can redeem for metal if you have $245,000 worth of silver or $700,000 worth of gold, and you want to jump through all those hoops and pay all those fees. The better thing is to go to a reputable dealer and buy physical metal and store it wherever they're storing it, And if you want to have delivery, those reputable dealers will actually arrange for the metal to be delivered by an insured carrier, and they'll take care of it. They're going to charge you something, but it's not going to be nearly as cumbersome and difficult and time consuming as the process getting your metal out of the RCM. So I've learned something this year. I've learned, that's really not a particularly attractive way to take delivery of metal. That's all I have for now. Have a good weekend. Enjoy it and stay clean, stay good, be good to yourself and be good to others. I'll talk to you next week.